Most people will go and say, I want to buy a house, so I'll just buy this, right? They haven't thought about anything else. I think 95% should be thought of before you even buy.
What would you say are the biggest mistakes that investors make?
Taking advice from the news, a person at a barbecue, the tooth fairy, the Easter bunny, I don't know.
Sam, thanks for joining us, mate.
No worries.
Compound Invest. So you're an investor buyer's agent. Can you tell us a little bit about what you do and how that works?
I actually, did it in the corporate world, then learned, obviously the ropes of how lending works and various other things.
Yes.
And you learn the market cycle, how it works, and should I say, when's a good time to buy a certain market, when's a bad time to buy another, how refinancing works. So the whole idea of Compound Invest is to help people actually build wealth the right way through real estate. And leveraging also through finance, because I'm sure you understand that, it's more a game of probably finance these days than it is,
right.
I'd say, a game of anything else.
Obviously, we're in Sydney. The other capital cities in those markets, how do they compare to what we're seeing currently in Sydney?
So Sydney's a little bit, it's funny. It's kind of like, I'd almost argue, a four-tiered market at the moment. You've got the top end of the market, which effectively does its own thing because it's a cash buying market. Market's 5 million above. So you can get Bellevue Hill that can do 30% a year, just no matter what interest rates are, because it's billionaires buying. So that's one end of the market. Then you've got I'd say the higher end of the mortgage market, which is probably $2 to $3 million, maybe 1.8 even, you could argue. That part is a little bit slower at the moment because interest rates are up. There's a bit of uncertainty about the economy, those other things. Then you've got the lower end, which pretty much is always in not massive demand, in some level of demand, because people have to live somewhere and they all will flood into the lower end when interest rates are up. It's very normal. Then you've got probably the end that's doing the best, and I'd almost call it the transport orientated end, which is your low to medium density housing code, your transport orientated plan affected suburbs, your density affected suburbs, because you've got height story limits of like 6 and 10 stories that were previously 3, 2 and 3, for example, where developers just want to snap up all the land. So that anything that's near that is doing quite well in Sydney, but it's not because of the general public. It's because of the, I'd say the larger scale investors, your holding companies, those sorts of guys who are coming in and buying it. So compared to some other cities, like though on an overall scale, I'd say Sydney, is, I'd say, probably fairly stagnant, maybe lightly growing, if you could say that. But Brisbane, Perth are rocketing along still. They're doing, like Perth did 2% last month or something like that.
Wow, last month.
In a month, So it's done 20% in the year. I think
year to date. We're not even end of quarter one yet.
No, not a year to date, pardon me, 12 months.
So last 12 months.
Gotcha. So that's,
okay, I was going to say,
it's March to March. But Brisbane's done the same 10% as well. So you'd think I'd call that a fairly boom year either way.
Absolutely.
But the market's running cycles. So like Sydney's had a crazy performance between about 2012 and 2019. Also, you had the obviously COVID 0.1% interest rate boom you had there as well. But Sydney will pick back up when it does. It's just the way cycles work. So that's kind of where we're at the moment.
Yeah, and that's exactly in line with what we're seeing at the moment. Obviously those, in our market, those $4+ million properties are the ones where the buyers are generally not affected by interest rate rises as much. It's that, 2 to 3 bracket where the lending really becomes important. And then obviously with this new first home buyer scheme as well, everything in that, $800K to 1.5 million bracket has almost jumped up the price bracket to allow for the new demand that's coming from buyers. But obviously you're out there, you're looking at properties, you're going to all these different states and cities and making sure that you lay your eyes on them. What would you say are the 3 most important things for your investors on a broad scale that you look for when purchasing property? Yeah,
so the first thing is, and it's one that most people ignore, it's actually what is your strategy and long-term game. That's always, most people will go and say, I want to buy a house, so I'll just buy this, right? And the reality is they haven't thought about what they're going to do. They haven't thought about anything else. And I'll get 3 to 5 calls, sometimes more a week, of people saying, I've already bought this property, what do you think? And I'm a straight shooter, so I say it's an absolutely crap buy. I would sell it and buy something better, right? And the reality is there's 2 reactions. One will say, one will be okay, what would you do? And they'll listen. The second one is, no, this is right because of X, Y, and Z. But the thing that then happens is generally over the next 2 to 4 weeks is they'll then come back to me and say, oh, you're actually right, because they've come to the realization themselves. And if you're buying a place, let's say for $1 million, right, you've got agent selling fees, and you've got stamp duty again to replace the same property. So that's $80,000. It's probably about 8% that you've probably lost in buying the wrong thing.
Yeah.
So first thing's definitely strategy. Most people don't think of, what they want to do.
Yeah, there's no plan.
No.
Yeah.
So that's the first thing. Secondly, I'd say to that as well is it goes kind of along with strategy, but it's what you buy in terms of like what you're intending to do to it. So everyone's got a different idea. Now, I have my different opinions on what the best thing to buy is, and I'll tell you that in a second. But most people these days, because they're lazy, they don't want to do any work to a property. Most people want something that's turnkey, rent ready, because they can't pick up a paintbrush. I don't know what's wrong with people.
Pick up a paintbrush, and also I find managing that process with external people.
Yes.
Especially, if you're a family, you've got kids, you've got a life, you've got things on. That just adds another layer of stress.
Right. Yeah. So that's another thing. It's also what you buy. Like you get people who, for example, might say, and it's also being truthful about what you want to buy. Like they might say, I want to buy a house and I'm happy to do work to it. But then when they get a building report and it says, for example, you need to fix waterproofing on a couple of the tiles in the bathroom,
and
they freak the hell out. Exactly. So someone like that isn't someone who wants to do work to a property. You're someone who wants a turnkey, to be honest with you. So, which mind you is probably 95% of people these days. It's the vast majority of people. Even people who say they want to do it, when it comes to it, they don't want to do it. The vast majority.
Because then they say the bill.
Correct. Yeah, that's right. Strategy probably covers all these things because it's what you buy goes into that.
Yes.
But it's also does it fit within your life and what you're going to do as well. So
super important.
I mean, someone, for example, who is young and let's say maybe a few people on the podcast might like this, but if you're under 40, you've still probably got at least 20 years of your life left of working. Most people probably do. If at minimum, maybe 15. So you've probably got, 1 to 2 market cycles, maybe 1.5 to 2, you could probably argue, left in your life. So someone like that, you're better to buy an asset anywhere with probably 15 to 20 years plus that is going to perform better in terms of capital growth over the long term. Granted, you can hold it.
Yes.
Whereas if you're retiring in 3 to 5 years, the capital growth long term doesn't matter that much. It's more so what's going to go up in the next few years, so you can bump your retirement savings maybe up by $200-300 grand or something like that. So your horizon. Then it's also do you want to have kids? What school do you want to send them to? Does this suit your life? Is your wife, for example, or one of you going to take off, should I say, work for your future, and what's it going to look like then? How are you going to afford mortgage repayments? How comfortable are you with, should I say, what's your risk profile? How comfortable? Yes. So a thing that I think a lot of people don't even think is, what is their risk profile? So, there's 2 elements of that. First of all, your appetite. How willing are you to take on risk? So, some people might have 200 grand in their bank account. Some might only want to spend 120 of that. Others will be happy to spend 190. So that's how much. And then the other part is also risk management. I'm sure you come across this in property management all the time.
Every single day.
Some people will want, for example, 6 or 12 months worth of savings in their account. They'll want, they'll only want to spend $50 to $100 a week to maintain a property or something like that in terms of negative cash flow, or they might even want it to be positive, a lot of people as well. Others will be happy to spend $1,000 a week to maintain an investment property simply with, the intention of it going up over the long term in value. So, most of what goes on, I think with what goes on in buying, 95% should be thought of before you even buy. What you buy is the cherry on top of the cake. The cake is the most important part.
Yeah, and that's actually leads on to my next point perfectly. What would you say are the 3 biggest mistakes that investors make when they're purchasing property? So
first of all is taking advice from the news, a person at a barbecue, so the tooth fairy, the Easter bunny, I don't know, anything like that. The average person, this is what they do. They look at where they live, wherever it is. Let's say you're in Summerhill.
Yeah.
They throw a 5K ring and basically draw a 5K ring around where they live. Now they might have, for example, let's say, I don't know, $1.8 million or something like that. Maybe they live in a wealthier part of the area. Maybe they live in, I don't know, Balmain East or something, where the house they've grown up in is $4.5 million or something like that. Now because they live there, they'll say, why don't I just buy a unit that's here or something like that on this street?
Close, it's convenient, it's comfortable.
My uncle I met at a barbecue or something like that the other day told me to buy on Darling Street in Balmain, right? So, but then they could, if they have 1.8, maybe they could buy a detached house or something like that, maybe in like a rundown one in Ashbury or Croydon Park or something like that they could do much better out of. So that's the first thing, they take the wrong advice. Secondly, on top of that as well is that when they actually go and look at a property as well, they don't take anyone's professional advice either. So a lot of people think they can do things on their own, but you got to remember, if you're looking to do something where professionals run it all the time, right, you're never going to be as good as a professional. So, for example, it's like you going to a surgeon and saying, I know more about surgery than you, when he's done it his whole life or studied it for 12 years or something like that, right?
Perfectly put.
So the final thing as well, I'd say, is when people go and look at a property, they don't go and look at what they should look at in a property. I'll give you a perfect example. A person will go and look at a property and they'll say, I really like this house because I like the kitchen. It's got an island, or it's got the Thermomix can go there, or something like that. I don't know, something along the lines of that, right? But every other room in the house is crap, or something like that, or just doesn't have the right features. It might be behind a big apartment complex, might be on the wrong side of the hill. That has a big effect. Even the street you're on has a big effect, right? Like, is it wide? Where it is? Like, what's the parking situation like, you know?
But mate, you touched on those people who are looking to get capital growth, you know, between 3 and 5 years, and then people who have a bit of a longer term plan. What are investors actually buying in 2026?
Yeah,
what are they leaning towards?
Well, around the country, a lot of them are chasing yields. So around the country, and the thing about investors is, the thing you got to remember is, when investors flood into an area, it's generally already too late when you buy there, because investors generally close out the cycle. They don't start the cycle.
Right.
The owner-occupiers start the cycle, which is the best time to buy. So you don't want to buy in an area where all investors are flooding, because it's generally too late to buy in the cycle. So a lot of investors are still targeting regional Queensland, regional WA, Perth, Brisbane, all these other areas, right? But they're targeting it after it's already gone up 80 to 110% in 5 years. And statistically speaking, that's actually the riskiest time to buy a suburb or property, because if you buy, then it'll eventually go through its downturn phase and stabilisation.
Yes.
Stabilisation phase of Perth can be 14 years. So between the year of 2008 and the year of 2022, Perth literally did 0%. Did zero. So there was a short period there in 2007 where Perth was only about 2.5% cheaper than Sydney. The average house in Perth was only 2.5% cheaper than Sydney.
And then in 2022, Sydney's 3 times as expensive.
So that's what people buying in terms of Sydney. Your smart people, though, I'd say, are starting to buy in these. Like, inner west suburbs are good examples of it. A lot of the smart ones who, now, granted, you have the money. That's the key thing I will say. And when I say have the money, you probably need at least 1.8 to 2 million plus.
Yeah. If we're talking about purely inner west,
you need that.
What are some of your hotspots?
I mean, if you look at Rozelle, Lilyfield, Balmain, anything like that, Petersham, Lewisham, Leichhardt, these are suburbs that have done 9.2 to 9.8% long-term growth. That's a 50-year growth, right? And statistically speaking, they've done about, literally, no word of a lie, 1 to 3% growth over the last 5 years. So, I mean, I'm sure the data nerds, maybe the people who are engineering spreadsheets guys and all that, will probably like me saying this, but markets over the long term are generally efficient. So if they've overshot their average in recency, they'll probably undershoot their average in the future. If they undershot their long-term performance in recency, they're probably going to overshoot in the future. So those areas haven't done very well over the last. Some parts of Balmain are the same price they were 7 or 8 years ago, which is crazy.
Yeah.
That's insane. And that's done 9.5%. Growth. So somewhere like that, if you have the money, I don't see how you lose any money long term. Now, when I say long term, I mean 10 plus years.
Yes.
Now, for me, if I'm buying a property, you're buying it for 10 plus years. You always buy it for at least 10 years.
Yeah, you're going to be holding it.
Because at $2.5 million, your stamp duty is like 120 grand minimum. Your deposit's probably going to be 500 grand, because if you're doing a 20% deposit. So it's a move is like minimum, like, if you're selling your house as well, that's probably another 120 grand.
Yeah.
So it's probably a 700 grand move. Literally, it's a 700 grand move. So, but that's where I'd be buying if you had even more money. So if you were, I'm probably talking about someone with maybe a 5 million plus budget, and probably developers as well. A 5 million plus budget. If you're buying a unit block, you're doing very well at the moment, and it's simply because I'm sure everyone would know what's going on in the greater scheme of the world, like obviously oil, Strait of Hormuz, all these things going on. Now, for people that don't understand how it works, crude oil basically runs the world. Yeah. If oil doesn't exist, the world ceases to exist how it is. Now, don't get me wrong, if you live in an Amazonian tribe, you can live how you are. But oil, because it's not only cars and vehicles that influence it, it also influences heavy machinery, so bricks, mortar, steel, aluminium, all those sorts of things. Yeah. So what you're going to see is you're going to see building costs probably go up 5 to 10% year on year for at least the next 5 years.
Yeah, wow.
So if you look at just the replacement value, so that's the land value plus what's on the block, a unit block, the land value might be $3 million or something like that. The land value in the West, maybe 2.5 to 3. But if you've got 8 units on it, that's probably minimum 500 grand to build each of them.
Yeah,
so that's 4 million. So if you're picking it up anything under, let's say 6.5 to 7 mil, you're already probably $1 million up in the replacement value of what you're buying.
Yeah.
So that's one. And then the other thing is, if you're a developer, there's a lot of zoning changes where you have low to medium density housing code, council zoning. Transport orientated plans, a massive one that affects the inner west as well, where it previously was a 2 to 3 height limit and now it's a 6 to 10. So you got these developers who come in, and this happened in Bondi only about a year ago, that are actually buying the airspace of the airspace. So
how does that work?
The top guys who own the actual. So you might have 4 units that are on the top of the block.
Yes.
So what they do is a developer will approach them and say, we'll pay you X amount of dollars if you let us build up, and then the strata company they'll also get permission and generally pay them a sum of money. But if you've already got the structure there, and they obviously have to get a geotech, a structural engineer, and various other people to obviously suss it out and understand what structures they need to actually build up. You might only, because the structure's already there, the plumbing's already there and everything, it might not cost 500 grand to build it. It might only cost 300 because most of the structure's already there.
Yes.
Then if you're in a good suburb of, let's say, the inner west, that you might sell an apartment for $800,000, you're up 500 on every unit you build. So that's another thing. If you're a developer and you have the money, and I hate to say access to the right block, that's a way you can make a lot of money as well. So it's obviously not a fair game for the average income earner, but if you have the money, like those are all, I'd say, really good buys at the moment, especially in the inner west of Sydney.
Yeah. And would you say there are still a lot of mum and dad investors out there?
There's plenty. There's quite a few who bought quite a number of years ago in the inner west, because obviously prices are, I'd say, fairly expensive. Now, the ones with lower budgets generally go into, other forms, so smaller, apartments, townhouses, various other things, or buy interstate, or, should I say intercity, maybe even in a different city of New South Wales or something like that. There's most of the mum and dads who are buying are either ones who have bought a number of years ago or have a lot of excess equity or cash saved up and then can go in again. Maybe one had a really big year in business or something like that. Or you got to remember, it's something I think from memory the stat is I think it's 71% of all investment properties are only own one property, and they're generally mum and dads. It's the vast majority of investors are mum and dad investors. The vast majority of them. So the reality is when interest rates go up, this is just also a reality for, I'd say, on the tenant side of things too, is that when you have mum and dad investors selling in key areas when they can't afford it, it's actually worse for tenants.
Yeah, exactly right.
Because the thing is, there is the argument of, obviously, yes, an owner-occupier can buy it, and that is true if you buy in an outer estate where it's affordable and everyone can afford to buy, for example, right? But it's not true in a good inner suburb because people want to live there. So what happens is it becomes even heavier owner-occupier, and there's less rental properties available on the market.
Stock.
That's just what happens.
Yeah.
So on the broader scheme of things, that's true in terms of that an owner-occupier will buy, but not in a good suburb because everyone wants to buy there anyway.
Yeah, exactly right. And that perfectly leads on to my next point. As an investor buyer's agent, obviously you're purchasing investments on behalf of your clients, and once they settle, they need these properties to be managed.
Correct.
So with the changing nature of property management in New South Wales, obviously the introduction of all the new rental legislation, what is it that you are advising your clients to look for when they're selecting a managing agent? Because in our world, we're seeing that property management has become less about rent collection and more about risk management with all of this stuff.
Yeah, so the first thing I try to make as evident to clients as possible is don't look at the percentage they charge per week and those fees. Because, I mean, for me, what I'd say is professional service, professional fee, crap service, crap fee. That's what I'd say. It's maybe a blunt way of putting it, but it's just the truth. So when you look at property management, for example, if you have a bad tenant, if you have one bad tenant, right, you're probably at a minimum of 3 months rent and probably a minimum of $15,000 worth of fixing a property up if you have one bad tenant.
Yeah. And even now with these new notice period laws, you've got to give specific reasons to terminate tenancies.
Yes,
so if you've got a tenant in your property and they're paying their rent on time, but they're just not looking after the place very well, there's nothing you can actually do.
No, completely. So I mean, the thing as well, I think, is understand how good your property manager is at holding relationships, because you've got to remember it's everything you do in life is always a two-way street if it involves more than one party, should I say.
Yeah.
So for people that have ever managed staff, for people that have ever been in a sports team or anything like that, you got multiple different personalities that are doing different things. Now, if you're too much so to the landlord's favour, right, the tenant's going to get really pissed off. If you're too much to the tenant's favour, the landlord's going to get really pissed off. So I'd say the most key thing in that is having a good relationship between, the understanding who your property manager is, what relationships they hold with their tenants and that kind of thing. I mean, a good way to suss a property manager out isn't by asking them what their fees are. It's just understanding who they, I think, are as a person and how they treat either party. Because if they treat either party well and they get on with either party well, you're probably not going to have too many issues. I mean, the other thing as well, I think, with renting a property out is you got to remember some people on board people try to promise the world and they underdeliver. That's the other thing. So a lot of investors, they try to be unrealistic, and obviously everyone wants to get the highest rent. I get that.
Yeah,
I get
of
that
course.
they can get because it obviously covers more costs, might make them a bit more money. I get that, right? But what you're really looking for is it's the net amount of money you have at the end of the day, and it's the least hassle as well. If you own a house in the inner west of Sydney or anywhere in Sydney, effectively, you're probably going to have to have a fair bit of money to at least be able to afford it.
Yeah.
And you're probably a busy professional, maybe a business owner, or someone who might have you could be working in the mines of FIFO or something like that.
Yeah.
So you're not going to have the time to call a property manager every week if something's going on.
Chase a leaking tap.
Right.
Yeah, that's
so
exactly right.
you want someone where you have a trust between, let's say it's, I don't know, a $1,500 approval limit or $2,000, whatever you want it to be, right? Me, I say $2,000 because I personally don't care. Like, if you trust your property manager enough, like they should be doing the job for you anyway. So for me, they're a property manager. That's their job. Let you do your thing. That's the way I'd understand it. But I mean, what I mean by that is a lot of them will say, oh, you'll have no issues. Instead of getting 800 a week, we'll get you 900, all this kind of thing. And yes, they might get you 900, but they'll pull someone off, not do any income verification checks. They won't do any checks on their background or anything like that. They'll sign up a lease without even taking a bond, without even lodging the bond or anything like that. And it's basically illegal on every level, should I say, almost. So it's something that, and because you're dealing with so much money, like that asset's probably worth a minimum $1 million in the inner west now, minimum, probably more. Do you really want them to stuff your asset up that's worth like $1 million plus?
Yeah, and like the role of property managers has changed in these last few years. We're finding that, and you touched on relationships, our relationship management with both our landlords and our tenants are super important. Mate, we want to make sure that everybody's looked after on both sides of the transaction. Obviously making sure that the tenant's paying rent on time and that the property's well looked after is a big factor for the landlord, but also making sure that if we get any requests for repairs and maintenance, that they're answered in a timely fashion, that we're communicative with the tenant. Because the reality is, if the tenant's got a good relationship with their property manager, they're going to probably want to stay in their property a little bit longer. So yeah, that property management experience, I think, with the introduction of all these new laws, the tech that's being used now, it's super, super important to make sure that you're managing your relationships on both sides of the fence. And that's our take on investor buying. Sam, thank you so much for joining us today. If you're in need of an investment property in Sydney or anywhere in Australia, Sam from Compound Invest is your man. We'll leave this link to his socials right here. And thank you very much. We'll see you on the next episode of Tripp's Take.